I've lived through more recessions than most people can count. The recession of 1953, when I was just getting started, the sharp downturn in 1957, the brutal bear market of 1973 to 74, the double dip recessions of the early 1980s, Black Monday in 1987, the dot-com crash in 2000, the financial crisis of 2008, the pandemic crash of 2020. And now, as we look toward 2026, there's growing concern about another potential recession. Each recession taught me something different, but they all reinforced the fundamental truth that most investors, especially those over 60, desperately need to understand. Recessions are not the time to hide in your bunker. They're actually one of the best opportunities to generate strong returns if you know what you're doing. The question I get asked most often by people in their 60s and 70s is how to grow their money at 8 to 10% while staying safe during uncertain times. Most financial advisors would tell you that's impossible. They'd say you have to choose between safety and returns. But I disagree. Let me be clear about something right from the start. When I talk about growing 8 to 10% safely during a recession, I'm not talking about guaranteed returns with zero risk. That doesn't exist. Anyone who promises you guaranteed high returns is either lying or selling something dangerous. What I'm talking about is building a portfolio that has historically generated 8 to 10% returns over complete market cycles, including recessions, with a level of risk that's appropriate for someone over 60 who can't afford to start over. The key insight that most people miss is that safety doesn't mean avoiding all volatility. Safety means avoiding permanent loss of capital. Those are two very different things. A portfolio that drops 20% during a recession but recovers and grows over the following years isn't unsafe. It's just volatile. A portfolio that's so conservative it can't keep pace with inflation is actually unsafe because it guarantees you'll lose purchasing power over time. That's a permanent loss, just a slow one. So let me walk you through exactly how I would structure a portfolio for someone over 60 who wants to achieve 8 to 10% returns while navigating a potential recession in 2026. This isn't theoretical. These are principles I've applied at Berkshire Hathaway for decades, adapted for individual investors who don't have billions to deploy. The foundation of this strategy is what I call quality equity investing. Even if you're over 60, you need significant exposure to stocks. I know that contradicts what many financial planners tell you. The traditional advice is to shift heavily into bonds as you age, maybe holding your age in bonds as a percentage. So a 65-year-old would hold 65% bonds, 35% stocks. I think that's way too conservative and actually increases your risk of running out of money. Here's why. If you're 65 today, you might live to 90 or 95. That's potentially 30 years of retirement. Over 30 years, inflation at just 3% will cut your purchasing power in half. If you're holding 65% in bonds yielding 4 or 5%, your real return after inflation is 1 or 2%. That's not enough to maintain your standard of living for 3 decades, especially when you're withdrawing money for living expenses. Instead, I'd recommend someone over 60 hold 50 to 60% in equities, with the rest in bonds and cash. Yes, that means accepting more volatility, but it also means having a fighting chance of generating the real returns you need to fund a potentially long retirement. And the stocks you own matter enormously. This isn't the time for speculative growth stocks or risky sector bets. You need quality. What do I mean by quality? I mean companies with these characteristics. First, they have durable competitive advantages, what I call economic moats. These are barriers that protect a business from competition and allow it to maintain profitability through good times and bad. Moats can come from strong brands, network effects, cost advantages, switching costs, or regulatory protection. Companies with wide moats can raise prices, maintain margins, and keep generating cash even when the economy contracts. Second, quality companies have strong balance sheets with manageable debt levels. During recessions, companies with too much debt can be forced into bankruptcy or distressed situations even if their underlying business is sound. They can't refinance debt when credit markets freeze. They have to slash operations or sell assets at fire sale prices. You don't want to own these companies. You want companies that could pay off all their debt tomorrow if they had to, Companies that view debt as a convenience rather than a necessity. Third, quality companies generate consistent free cash flow. Free cash flow is the money left over after a business pays for all its operations and capital expenditures. It's the cash available to pay dividends, buy back shares, reduce debt, or make acquisitions. Companies with strong free cash flow can weather recessions without cutting dividends or taking desperate measures. They can even go on offense, buying competitors at distressed prices or investing in growth while others retrench. Fourth, quality companies have proven management teams with track records of navigating difficult periods. Recessions test management. They reveal who has been swimming naked when the tide goes out, as I like to say. You want management teams that have been through downturns before and made smart decisions. Teams that maintain long-term focus rather than panicking into short-term moves. Teams that treat shareholders as partners rather than marks. So what specific stocks fit these criteria? Let me give you some examples, though I'm not telling you to buy these exact companies without doing your own research. These are illustrations of the type of business I'm describing. Coca-Cola is the quintessential quality stock for a recession portfolio. I've owned Coke since 1988 and watched it perform through multiple recessions. During economic downturns, people still buy Coca-Cola products. A Coke costs $2 or $3. It's an affordable, small pleasure that people don't give up, even when money is tight. The brand is one of the most valuable in the world. The distribution network is unmatched. The company generates billions in free cash flow annually. The dividend has been raised for over 60 consecutive years. During the 2008 financial crisis, Coca-Cola's earnings barely budged. The stock price fell along with everything else during the panic, but the business kept humming. If you held through the crash and kept collecting dividends, you did just fine. That's what you want from quality stocks, business stability, even when stock prices are volatile. Johnson & Johnson is another example. Healthcare is one of the most recession-resistant sectors because people need medicine and medical care regardless of economic conditions. Johnson & Johnson has a diversified business across pharmaceuticals, medical devices, and consumer health products. The balance sheet is fortress strong, one of only 2 companies in America with a AAA credit rating. The dividend has been raised for over 60 consecutive years. During recessions, J&J keeps making money and paying shareholders. Procter & Gamble sells consumer staples that people buy in good times and bad. Toothpaste, laundry detergent, diapers, toilet paper. These aren't discretionary purchases that get cut during recessions. P&G owns some of the strongest consumer brands in the Tide, Crest, Gillette, Pampers, Charmin. The company has pricing power, meaning it can raise prices to offset cost increases without losing customers. That's incredibly valuable during inflationary or recessionary periods. The dividend has been paid for over 130 years and raised for over 65 consecutive years. Berkshire Hathaway, my own company, is designed to perform well during recessions. We own a diversified collection of businesses across insurance, railroads, utilities, manufacturing, and retail. We have over $150 billion in cash and treasury bills, giving us enormous flexibility to take advantage of opportunities during downturns. We have minimal debt at the holding company level. Our insurance businesses actually benefit from higher interest rates because they can invest their float at better returns. During 2008, Berkshire was one of the few sources of capital willing to invest when everyone else was panicking. Apple might surprise some people on this list because it's a technology company. But I think of Apple differently. To me, it's a consumer products company with a technology wrapper. The iPhone is not a luxury item anymore. It's essential infrastructure for daily life. People will sacrifice other things before they give up their iPhone. The brand loyalty is extraordinary. The ecosystem creates massive switching costs. The services business generates recurring revenue that's more stable than hardware sales. And the balance sheet has tens of billions in net cash. These are just examples. The point is that your equity allocation should be concentrated in businesses like these: wide moats, strong balance sheets, consistent cash generation, proven management. You don't need to own 50 stocks. 10 to 15 quality companies across different sectors provides adequate diversification while maintaining the focus on quality that protects you during recessions. Now let me talk about dividend income, because this is crucial for generating returns safely when you're over 60. Dividends provide a return you can count on, regardless of what stock prices do. When you own Coca-Cola yielding 3%, you're getting that 3% whether the stock goes up, down, or sideways. During recessions, when stock prices fall, those dividend checks keep arriving. They provide income and psychological comfort. More importantly, quality dividend stocks tend to raise their dividends over time. A 3% yield today becomes a 4% yield on your original investment in a few years if the company raises dividends at 6 or 7% annually. After 10 or 15 years, you might be getting 6 or 7% yield on your original cost. That growing income stream is a powerful way to generate returns and protect against inflation. I'd focus the equity portion of the portfolio on companies with long histories of dividend growth. The dividend aristocrats, companies that have raised dividends for at least 25 consecutive years, are a good hunting ground. These companies have proven they can maintain and grow dividends through recessions, inflation, wars, and all kinds of economic turmoil. That track record matters, but don't chase yield blindly. A stock yielding 8% might look attractive, but that high yield often signals trouble. Maybe the market expects the dividend to be cut. Maybe the company is in a declining industry. Maybe the payout ratio is unsustainably high. I'd rather own a stock yielding 3% with a safe payout and strong growth prospects than one yielding 8% that might cut its dividend next quarter. Now let's talk about the bond and fixed income portion of the portfolio. I'd allocate 30 to 40% here for someone over 60, split between government bonds and high-quality corporate bonds. The purpose of this allocation is to provide stability, income, and dry powder to deploy if stocks get really cheap during a recession. For the government bond portion, I'd focus on short to intermediate term Treasury securities. 5-year Treasuries, 7-year Treasuries, maybe some Treasury inflation protected securities for inflation protection. I would avoid long-term bonds like 30-year Treasuries. Long-term bonds are very sensitive to interest rate changes. If rates rise, long-term bond prices fall sharply. That's the opposite of the stability you're seeking. Currently, short-term Treasuries yield 4 to 5% with essentially zero credit risk. That's actually a decent return for the safety portion of your portfolio. It's not going to make you rich, but it provides income and ballast during stock market storms, and it gives you liquid assets to redeploy into stocks if prices fall significantly during a recession. For the corporate bond portion, stick with investment-grade debt from companies with strong balance sheets. The same companies that make good equity investments often make good bond investments. Microsoft bonds, Johnson & Johnson bonds, Berkshire Hathaway bonds. These companies aren't going bankrupt. Their bonds are almost as safe as treasuries, but yield a bit more, maybe an extra 50 to 100 basis points. I'd avoid high yield or junk bonds for this portfolio. Yes, they offer higher yields, but they also carry significant credit risk. During recessions, default rates on junk bonds spike dramatically. Companies that were already financially stressed before the recession often can't survive when revenue declines and credit markets tighten. You don't want to be holding their bonds when that happens. The bond allocation also serves as your recession response fund. Here's what I mean. If we enter a recession in 2026 and stock prices fall 30 or 40%, that's an opportunity to buy quality stocks at bargain prices. You can sell some bonds which will likely have held their value or even appreciated during the flight to safety, and use the proceeds to buy stocks when they're cheap. This systematic rebalancing, selling what's high and buying what's low, improves returns over time. This is exactly what I do at Berkshire. We maintain a huge cash and bond position, not because we love earning 4%, but because it gives us the ability to strike when opportunities arise. During 2008, when everyone else was frozen in fear, we were able to invest in Goldman Sachs, General Electric, and other companies at extremely attractive terms. That firepower came from the liquidity we maintained during good times. Now let me talk about cash, which I'd keep at 5 to 10% of the portfolio. This serves as your emergency fund and your opportunity fund. In a money market account or short-term treasuries, you're currently earning 4 to 5% with daily liquidity. That's the best deal on cash I've seen in years. The emergency fund portion covers unexpected expenses without forcing you to sell investments at bad times, medical bills, home repairs, family emergencies, whatever comes up. Having 6 months to a year of living expenses and readily accessible cash means you're never forced to sell stocks during a crash to pay bills. The opportunity fund portion is there for when exceptional opportunities arise. Maybe a company you've always wanted to own gets cut in half during a recession panic. Maybe there's a specific opportunity in your local market, a small business for sale or real estate at distressed prices. Having cash available lets you act when others can't. Now let me address the big question. How does this portfolio generate 8 to 10% returns during a recession? Let me walk through the math. The equity portion, which is 50 to 60% of the portfolio, has historically returned about 10% annually over long periods. During recessions, stock returns are lower or negative, but over complete market cycles that include recessions and recoveries, the 10% historical average holds. Quality dividend stocks might return slightly less than the overall market during bull runs, but hold up much better during downturns, smoothing the ride. The bond portion, 30 to 40%, currently yields 4 to 5%. That's not going to generate 8 to 10% returns, but it provides stability and income. More importantly, it gives you assets to redeploy into stocks when they're cheap. The cash portion, 5 to 10%, yields 4 to 5% currently. Again, not exciting, but it provides liquidity and optionality. Blending these together and assuming you systematically rebalance by selling bonds and buying stocks when stocks fall significantly, and assuming you reinvest all dividends and interest, a total return of 8 to 10% annualized over a full market cycle is achievable. Not every year. That's crucial to understand. Some years you'll make 15%. Some years you'll lose 5%. But over 5 to 10 year periods that include a recession and recovery, 8 to 10% total returns are realistic for a quality-focused portfolio. The key is not panicking during the downturn. If you sell stocks when they fall in 30%, you lock in losses and miss the recovery. If you hold through the volatility and even add to positions when prices are low, you capture the full cycle return. That requires emotional discipline, which brings me to my next point. Let me talk about the psychological preparation required for this strategy. Generating 8 to 10% returns during a recession means staying invested through the recession. And staying invested during a recession is one of the hardest things in investing. Your portfolio will decline. You'll watch 30 or 40% of your account value evaporate temporarily. Every instinct will tell you to sell and stop the bleeding. Here's how I prepare psychologically for downturns. First, I remind myself what I own. I don't own ticker symbols or lines on a chart. I own pieces of actual businesses. Coca-Cola will still be selling drinks during the recession. Johnson & Johnson will still be making medicines. Procter & Gamble will still be selling toothpaste. The businesses continue operating regardless of what Mr. Market does on any given day. Stock prices eventually follow business value. If I own good businesses, temporary price declines are just noise. Second, I remember history. Every recession ends. Every bear market is followed by a bull market. The financial crisis of 2008 felt like the end of capitalism. It wasn't. Within a few years, stocks had recovered and gone on to new highs. The pandemic crash of 2020 was terrifying. Within months, stocks had fully recovered. Recessions are temporary. The long-term upward trajectory of American business is not. Third, I don't check my portfolio constantly. During volatile periods, I might look once a month or once a quarter. The less frequently I look, the less volatility I see, and the less tempted I am to do something stupid. Daily price checking during a recession is a recipe for emotional decision making. Just don't do it. Fourth, I have my bond and cash allocation providing stability and income. Knowing that I have 2 to 3 years of living expenses in stable assets lets me ignore stock price volatility. I don't need to sell stocks for living expenses. I can wait as long as necessary for recovery. Fifth, I view recessions as opportunities, not threats. When stocks are down 30%, I'm buying shares of great businesses at bargain prices. Every dividend I receive is buying more shares at depressed prices. Every rebalancing from bonds to stocks is deploying capital when it has the most potential for appreciation. Recessions are when fortunes are made for those with the courage and resources to act. Let me talk about specific tactics for navigating the recession itself. When economic data starts deteriorating and it becomes clear we're in or entering a recession, there are several things I would and wouldn't do. What I would do: continue investing regularly. Keep buying quality stocks with new savings or reinvested dividends. Maintain or slightly increase my equity allocation through rebalancing. Focus on companies that are actually cheap relative to their long-term earnings power, not just down from recent highs. Look for opportunities in individual securities that might be especially mispriced due to forced selling or irrational panic. What I wouldn't do: sell stocks because prices are falling. Try to time the bottom of the market. Shift to an all-cash or all bond portfolio. Buy cyclical or leveraged companies betting on a quick recovery. Let news headlines dictate my investment decisions. Check my portfolio daily and obsess over short-term movements. The difference between successful and unsuccessful recession investing is almost entirely behavioral. The strategy I've described is simple. The psychology is hard. Most people know what they should do but can't actually do it when fear takes over. If you can master the psychology, the strategy works. Now, let me address some specific concerns that people over 60 have about recession investing. What if I need to withdraw money for living expenses? This is why the bond and cash allocation is so important. You should have enough in stable assets to cover 2 to 3 years of withdrawals without touching stocks. During a recession, you live off bonds and cash while letting stocks recover. By the time you've depleted the bond portion, stocks have usually bounced back and you can replenish bonds by selling stocks at higher prices. What if the recession's worse than expected and stocks fall 50% or more? This is why we own quality companies with fortress balance sheets. They can survive even severe recessions. And if stocks fall 50%, you're buying at half price with your dividend reinvestments and rebalancing. Yes, it's painful in the moment, but the companies survive and eventually recover. The key is not having to sell at the bottom. What if I die before stocks recover? This is a valid concern for older investors. If you're 85 with serious health issues, maybe you shouldn't be 50% in stocks. But for a healthy 65-year-old with a potential 30-year time horizon, temporary drawdown shouldn't drive the strategy. And if you do pass away during a recession, your heirs get a stepped-up cost basis on the depressed shares. The temporary paper losses disappear for estate purposes. What about healthcare costs in a recession? Healthcare expenses increase with age, and a recession doesn't change that. This is another reason for the cash and bond allocation. Medical expenses often arise suddenly. Having liquid assets to cover them without selling stocks is important. Also consider that Medicare covers most major health expenses for those over 65. Supplemental insurance like Medigap or Medicare Advantage can cap out-of-pocket costs. What if I lose my job in a recession? If you're still working in your 60s, job loss during a recession is a real risk. This reinforces the importance of the emergency fund. Having 12 months of expenses in cash means you can handle a lengthy job search without touching investments. You might also consider having additional liquid reserves if you're in a cyclical industry or your job security is questionable. Let me talk about the role of alternative investments for recession-proofing a portfolio. Some advisors recommend alternative investments like private equity, hedge funds, commodities, or real estate for diversification and downside protection. My view on these is generally skeptical. Private equity and hedge funds typically charge high fees that eat into returns. Their performance is often no better than simple index funds after accounting for fees. They're also illiquid, meaning you can't access your money quickly if needed. And during severe recessions, they can be among the worst performers as their leverage strategies blow up. Commodities like gold are often touted as recession hedges. Gold doesn't produce anything. It just sits there and costs money to store. Its value depends entirely on what someone else will pay for it. I've never owned gold at Berkshire and don't recommend it for individual investors. If you're worried about extreme scenarios like currency collapse, a small gold allocation might provide psychological comfort, but I wouldn't bet on it generating returns. Real estate can be a good long-term investment, but it's not particularly recession-proof. Commercial real estate values and rental income typically fall during recessions. Residential real estate held up better historically, but still suffered during the 2008 crisis. Real estate is also illiquid and requires active management. For most people over 60, I'd stick with financial assets rather than direct real estate investment. Real estate investment trusts, or REITs, offer real estate exposure with liquidity. Some REITs own properties that are relatively recession resistant, like healthcare facilities, essential retail, or apartment buildings in supply-constrained markets. A small REIT allocation might make sense for diversification, but don't expect them to avoid declines during recessions. They'll fall with the market, they just might recover differently. The alternative I do like is Treasury inflation-protected securities, or TIPS. These are government bonds whose principal adjusts with inflation. They provide explicit inflation protection, which is valuable for retirees worried about purchasing power. During periods of unexpected inflation, TIPS outperform regular bonds. I'd consider allocating a portion of the bond allocation to TIPS for inflation hedging. Let me discuss the specific mechanics of implementing this strategy. You need brokerage accounts set up with the right features. Tax-advantaged accounts like IRAs and 401ks should hold your bond allocation because bond interest is taxed at ordinary income rates. Stocks, especially dividend-paying stocks, should generally go in taxable accounts because qualified dividends and long-term capital gains receive preferential tax treatment. Within your accounts, I'd use a combination of individual stocks and low-cost index funds. For the quality equity portion, you can buy individual stocks of the companies I described: Coca-Cola, Johnson & Johnson, Procter & Gamble, and others, if you want to handpick your holdings. Or you can use dividend-focused ETFs like the Vanguard Dividend Appreciation Fund or the Schwab U.S. Dividend Equity ETF that own baskets of quality dividend payers. For broader equity exposure beyond dividend stocks, a simple S&P 500 index fund works well. Vanguard's fund charges just 0.03% annually. The S&P 500 includes many quality companies and provides diversification across sectors. For bonds, you can buy individual Treasury securities directly from treasurydirect.gov or use bond ETFs. Individual bonds have the advantage of returning par value at maturity regardless of interest rate movements in between. Bond ETFs have the advantage of diversification and liquidity, but can fall in value when interest rates rise. For most people, short to intermediate term Treasury ETFs like the iShares 3 to 7 year Treasury bond ETF provide a good balance. Rebalancing should happen at least annually or whenever allocations drift significantly from targets. If stocks rise and become 65% of your portfolio when your target is 55%, sell some and buy bonds. If stocks fall to 45%, sell some bonds and buy stocks. This systematic rebalancing enforces buy low, sell high discipline. Dividend reinvestment should be automatic. Every dividend you receive should immediately purchase additional shares of the stock that paid it. This compounds your ownership over time and ensures you're buying more shares when prices are low. Now let me address what might happen specifically in a 2026 recession. I can't predict the future, and anyone who claims to know exactly when a recession will start or how severe it will be is lying. But I can discuss how different types of recessions might affect this strategy. If we have a mild recession with a modest stock decline of 15 to 20%, the strategy works beautifully. Your quality stocks hold up better than the market, dividends keep flowing, and the recovery is quick. You barely notice it in terms of your long-term returns. If we have a moderate recession with stock declines of 30 to 40%, similar to the early 2000 recession, the strategy still works but requires more patience. Your portfolio will decline meaningfully, but not as much as the overall market because of your quality focus and bond allocation. Dividends provide income and psychological support. Rebalancing from bonds to stocks captures value at lower prices. Within 2 to 3 years, you're likely recovered and hitting new highs. If we have a severe recession like 2008 with stock declines of 50% or more, the strategy is tested but survives. This is where owning companies with fortress balance sheets matters most. Weak companies fail during severe recessions. Strong companies survive and emerge stronger. Your dividend income might decline if some companies cut payments, but quality dividend payers largely maintain their dividends even in severe downturns. The recovery takes longer, maybe 3 to 5 years, but it happens. And if you've been systematically rebalancing and reinvesting dividends at depressed prices, your returns during the recovery are exceptional. The only scenario where this strategy truly fails is if you abandon it at the worst moment. If you panic in the depths of a recession and sell everything, you lock in losses and miss the recovery. That's why psychological preparation is so important. The strategy works over complete cycles, but only if you stick with it through the scary parts. Let me close with some perspective on what 8 to 10% returns actually mean for someone over 60. If you're 65 with $500,000 saved and you generate 8% annual returns while withdrawing 4% for living expenses, your portfolio continues to grow. After 10 years, you might have $600,000 or more despite a decade of withdrawals. After 20 years, you might have $700,000 or more. Your money can last indefinitely if returns exceed withdrawals. Compare that to a conservative strategy generating 4% returns. With 4% returns and 4% withdrawals, your portfolio is flat at best. More likely, you're slowly depleting it because inflation increases your expenses over time. Within 20 years, you could be running low on money. The difference between 4% and 8% returns is the difference between financial security and financial stress in retirement. That's why it's worth taking thoughtful equity risk, owning quality companies through recessions, and maintaining the discipline to stay invested when others panic. You don't need to hit home runs or make brilliant market calls. You just need to own quality, stay diversified, keep costs low, reinvest dividends, rebalance systematically, and resist the urge to sell during downturns. Do those things consistently for a decade or two, and 8 to 10% returns are not just achievable, but probable. That's how I would approach growing 8 to 10% safely during a 2026 recession if I were over 60. It's not complicated. It's not sexy, but it works. It's worked for me for 8 decades, and it will work for you if you have the patience and discipline to follow it. Remember, recessions are temporary. Quality is permanent, and your behavior during difficult times determines your financial outcome more than any specific investment you choose. Stay the course, trust the process, and use recessions as opportunities rather than threats. That's the path to achieving strong returns safely at any age, including over 60. Now let me go deeper on some specific topics that deserve more attention for investors over 60 navigating a potential recession. Let's talk about withdrawal strategies in detail, because how you take money out of your portfolio during a recession is just as important as how the portfolio is constructed. The traditional approach is the 4% rule. Withdraw 4% of your portfolio in year one of retirement, then increase that dollar amount by inflation each year. On a $500,000 portfolio, that's $20,000 in year one, then $20,600 if inflation is 3%, and so on. The 4% rule was designed to give a high probability of not running out of money over a 30-year retirement based on historical market returns. But it has limitations, especially during recessions. If you rigidly withdraw the same inflation-adjusted amount regardless of market conditions, you're forced to sell more shares when prices are low. This sequence of returns risk can deplete your portfolio much faster than expected if you experience a major downturn early in retirement. My preferred approach is flexible withdrawals. In good years when your portfolio is up significantly, you can withdraw a bit more, maybe 5% instead of 4%. Enjoy the gains. Take that trip you've been putting off. Help the grandchildren. But in bad years when your portfolio is down, tighten your belt. Withdraw 3% or even 2.5%. Cut discretionary spending. Postpone major purchases. Wait for recovery before resuming normal withdrawals. This flexibility dramatically improves portfolio survival rates. You're not mechanically depleting assets during downturns. You're giving your portfolio room to breathe and recover. The math shows that even modest flexibility, reducing withdrawals by 20% during down years, can add 5 or more years to portfolio longevity. Another approach I like is the bucket strategy. Divide your portfolio into 3 buckets based on when you'll need the money. Bucket 1 is cash and short-term bonds covering 1 to 2 years of expenses. This is your immediate spending money, completely insulated from stock market volatility. Bucket 2 is intermediate bonds and stable dividend stocks covering years 3 through 7. This provides income and moderate growth while being less volatile than pure equities. Bucket 3 is growth-oriented stocks for years 8 and beyond. This has time to recover from any recession before you need to tap it. When a recession hits, you live off Bucket 1 while leaving Buckets 2 and 3 alone to recover. As Bucket 1 depletes, you refill it from Bucket 2. As Bucket 2 depletes, you refill it from Bucket 3, but only when stock prices have recovered. This systematic approach removes the need to sell stocks at depressed prices for living expenses. The bucket strategy also provides enormous psychological comfort during recessions. When your neighbors are panicking because their portfolios are down 30%, you can calmly point to your Bucket 1 and say, I have 2 years of expenses in cash. I don't need to touch my stocks. That peace of mind helps you avoid emotional decisions that destroy wealth. Let me talk about Social Security timing, because this decision interacts importantly with your recession strategy. You can claim Social Security as early as age 62 or as late as age 70. Claiming early permanently reduces your monthly benefit by about 30% compared to full retirement age, which is 67 for most people today. Delaying until 70 increases your benefit by about 24% compared to full retirement age. The break-even analysis depends on life expectancy. If you live to your mid-80s or beyond, delaying until 70 produces more total lifetime benefits. If you die in your early 70s, claiming early would have been better. On average, the break-even age is around 80 to 82, but here's how this relates to recession planning. Social Security is an inflation-adjusted guaranteed income stream that continues for your entire life. It's essentially the best annuity you can buy. If you can afford to delay claiming while using portfolio withdrawals to fund early retirement years, you maximize this valuable guaranteed income. However, there's a scenario where claiming earlier might make sense. If delaying would require heavy portfolio withdrawals during a recession, suppose you're 64 when a recession hits and your portfolio is down 30%. Rather than selling stocks at depressed prices to fund living expenses while waiting for Social Security at 70, it might make sense to claim at 62 or 64. Accept the reduced benefit and preserve your portfolio for recovery. This is a complex decision that depends on your specific situation, including your portfolio size, expected longevity, other income sources, and the severity of the recession. But the key insight is that Social Security timing and portfolio withdrawal strategy should be coordinated, not decided in isolation. For married couples, coordination is even more important. Generally, the higher earner should delay until 70 because their benefit becomes the survivor benefit when one spouse dies. The lower earner might claim earlier. But again, if this requires depleting the portfolio during a recession, the math might change. Work with a financial planner to model different scenarios. Let me discuss tax strategies during recessions, because smart tax planning can add meaningful value to your returns. Recessions create both challenges and opportunities on the tax front. One major opportunity is tax loss harvesting. When your taxable account holdings are down, you can sell them to realize capital losses. These losses can offset capital gains elsewhere in your portfolio, and up to $3,000 per year can offset ordinary income. Unused losses carry forward to future years. This is essentially turning paper losses into tax benefits. The key is to maintain your investment exposure while harvesting losses. You can't sell a stock at a loss and immediately buy back the same stock. That's a wash sale, and the loss is disallowed. But you can sell one stock and buy a similar but not identical stock. Sell the Vanguard S&P 500 fund and buy the Schwab S&P 500 fund. They're virtually identical but not the same security, so you realize the loss while maintaining S&P 500 exposure. Tax loss harvesting is most valuable in taxable accounts for high-income investors. If you're in the 24% federal bracket and harvest $10,000 in losses that offset ordinary income, you save $2,400 in federal taxes plus any state taxes. Do this consistently during market downturns and you can add meaningful value over time. Another opportunity during recessions is Roth conversions. When your traditional IRA holdings are down 30%, you can convert to a Roth at the depressed value, paying taxes on a smaller amount. If you convert 100,000 from traditional to Roth when markets are at highs, you pay taxes on 100,000. If you convert the same shares when they're down to 70,000 during a recession, you pay taxes on 70,000. Either way, you own the same number of shares, but you've saved taxes on 30,000 the value. Roth conversions are especially valuable if you're in a lower tax bracket now than you expect to be later, or if you expect tax rates to rise generally. The money grows tax-free in the Roth and comes out tax-free in retirement. For those over 60 with a potential 30-year retirement, the tax-free growth can be enormously valuable. A third tax consideration is managing income to control Medicare premiums. Your Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years prior. If your income exceeds certain thresholds, you pay income-related monthly adjustment amounts, or IRMA, that can add hundreds of dollars per month to your premiums. The thresholds are relatively low, starting around $100,000 for individuals and $200,000 for couples. Large Roth conversions, capital gains realizations, or required minimum distributions can push you over these thresholds and trigger higher Medicare costs for 2 years. During a recession, you might be able to manage income more carefully because you're selling assets at losses rather than gains. This is a time to do Roth conversions while staying under IRMA thresholds if possible. Coordinate your tax planning with your healthcare cost planning for optimal results. Now let me share some historical examples of how quality-focused portfolios performed during past recessions. These aren't hypothetical. They're actual results from real market downturns. During the 2000 to 2002 dot-com crash and recession, the S&P 500 fell about 49% from peak to trough. Technology stocks were devastated, with the Nasdaq falling nearly 80%. But quality dividend-paying stocks in sectors like consumer staples and healthcare held up much better. Coca-Cola fell about 25% peak to trough, roughly half the market decline. Johnson & Johnson fell about 15%. Procter & Gamble fell about 30%. These companies continued paying and raising dividends throughout the downturn. An investor who held quality dividend stocks through that recession and kept reinvesting dividends recovered much faster than the overall market. By 2005, they were back to new highs while the Nasdaq didn't recover its 2000 peak until 2015. Quality made an enormous difference. During the 2008 financial crisis, the S&P 500 fell about 57% from peak to trough. This was the worst crash since the Great Depression. Financial stocks were destroyed, with many banks failing entirely, but again, quality consumer staples and healthcare stocks held up better. Coca-Cola fell about 30%. Johnson & Johnson fell about 25%. Procter & Gamble fell about 35%. Painful, but much better than the overall market. More importantly, these companies maintained their dividends. Coca-Cola actually raised its dividend in 2008 and 2009. Johnson & Johnson raised its dividend. Procter & Gamble raised its dividend while other companies were slashing payments or eliminating them entirely. Quality dividend growers kept the income flowing. An investor who stayed the course through 2008 kept reinvesting dividends at depressed prices and maybe even added to positions during the panic did exceptionally well over the following decade. The 2010 through 2020 period was one of the greatest bull markets in history, and those who were fully invested captured the full gains. During the 2020 pandemic crash, the S&P 500 fell about 34% in just over a month. It was the fastest decline in history, but it was also the fastest recovery in history, with markets hitting new highs by August. Quality stocks fell with everything else during the panic, but recovered quickly because the businesses remained fundamentally strong. The lesson from all these examples is consistent. Quality companies with strong balance sheets and durable competitive advantages decline less during recessions and recover faster after them. Dividends provide income and psychological support during the downturn. Staying invested and reinvesting dividends at low prices magnifies returns during the recovery. The strategy works if you have the patience and discipline to stick with it. Let me discuss some specific recession playbook moves that can enhance returns. These are tactical adjustments you might consider as a recession unfolds, beyond the basic strategy I've described. First, consider increasing equity allocation modestly when stocks are down significantly. If your target is 55% stocks and a crash takes you to 45%, rebalancing gets you back to 55%. But you might consider going to 60%, temporarily overweighting stocks when they're on sale. When markets recover, you rebalance back to 55%, having captured extra upside from the overweight. This requires emotional discipline and available liquidity. You're essentially buying more when everyone else is selling, but it's one of the best ways to enhance returns during recessions. Be systematic about it. Increase equity allocation by 5 percentage points when stocks fall 25% from highs. Another 5 points, they fall 40%. Have rules in advance so you're not making decisions in the heat of panic. Second, look for specific quality stocks that are especially mispriced. During recessions, everything gets sold indiscriminately. Quality companies get dumped along with junk. This creates opportunities to buy wonderful businesses at bargain prices. In 2008, I found opportunities to invest in Goldman Sachs and General Electric on terms that were incredibly favorable to Berkshire. During the 2020 pandemic crash, many quality stocks briefly traded at dividend yields of 4 or 5%, levels that hadn't been seen in years. Investors who bought those stocks captured both the high yields and the subsequent price appreciation. You probably won't find the same opportunities I have access to, but you can look for quality stocks in your universe that are trading at unusual discounts to their historical valuations. If a company you know and trust typically trades at 20 times earnings and suddenly trades at 12 times because of recession panic, that might be an opportunity. Third, consider adding to positions in companies with recession-resistant business models. During a recession, not all businesses suffer equally. Discount retailers like Walmart and Costco often see increased traffic as consumers trade down from premium options. Healthcare companies continue selling essential medicines and services. Utilities keep collecting monthly bills. These businesses can actually gain market share during recessions as weaker competitors struggle. Increasing positions in recession-resistant companies during the downturn sets you up well for the recovery. You're buying stability at discounted prices. When the recession ends, you own more of the companies that held up best. Fourth, avoid the temptation to bottom fish in highly cyclical or damaged sectors. During every recession, some stocks fall 80 or 90%. People think they're getting bargains. Often they're catching falling knives. Banks in 2008, energy stocks in 2020. These sectors had fundamental problems beyond just recession. Many companies failed entirely. Others took years to recover. Stick with quality. Don't try to pick the bottom in beaten down sectors unless you have genuine expertise. The goal is 8 to 10% returns safely, not hitting home runs by catching the exact bottom in the most damaged stocks. Fifth, maintain dry powder for exceptional opportunities. During severe recessions, there are sometimes opportunities to deploy capital at truly extraordinary terms. In 2008, I was able to invest in Goldman Sachs with a 10% preferred dividend plus warrants that ended up being worth billions. Those terms were only available because credit markets were frozen and companies desperately needed capital. You probably won't have access to preferred stock deals with investment banks, but you might find real estate at distressed prices, or small business opportunities, or other investments that only become available during severe economic stress. Having cash available lets you act on these opportunities. Let me address income planning specifically, because generating income during a recession is a common concern for those over 60. The strategy I've described focuses on total return, combining dividend income with capital appreciation. But some people prefer or need a pure income approach where they never touch principal. A pure income strategy during a recession is challenging because dividend cuts can occur even among quality companies. In 2008, some companies that had paid dividends for decades were forced to cut or eliminate payments. General Electric, for example, cut its dividend for the first time since the Great Depression. To build a more resilient income stream, focus on companies with strong dividend coverage ratios. The payout ratio is dividends divided by earnings. A company paying 50% of earnings as dividends has a cushion. Earnings can fall 50% before the dividend is threatened. A company paying 90% of earnings as dividends is vulnerable to any earnings decline. Also, diversify your income sources across sectors. If all your dividend stocks are banks and financial services, a financial crisis devastates your income. If you're spread across consumer staples, healthcare, utilities, industrials, and financials, sector-specific problems affect only a portion of your income. Treasury bonds and high-quality corporate bonds also provide income that's less vulnerable to economic conditions. The U.S. government won't default on Treasury interest. Microsoft won't default on its bond payments. This fixed income provides ballast when dividend income might be uncertain. Consider building a bond ladder specifically for income. Buy individual bonds maturing every year for the next 10 years. Each year, a bond matures and you have income to spend. If interest rates rise, you reinvest the matured proceeds at higher rates. If rates fall, you're locked in at the older, higher rates for bonds that haven't matured yet. This provides predictable income with minimal interest rate risk. Now let me discuss the importance of maintaining perspective during recessions. When you're in the middle of one, it feels like it will never end. The news is relentlessly negative. Experts predict further declines. Friends and family are panicking. Maintaining perspective is one of the hardest things in investing. Remember that you've lived through recessions before. Think back to how you felt during 2008 or 2020. The fear was real and justified. But the world didn't end. Markets recovered. Life went on. The same will be true of the next recession. Remember that recessions are normal parts of economic cycles. They've occurred roughly every 10 years throughout American history. They clear out excesses, reallocate resources, and set the stage for the next expansion. They're painful but necessary and temporary. Remember that stock prices reflect future expectations, not just current reality. By the time everyone agrees we're in a recession, stock prices have usually already adjusted downward. And before anyone is confident the recession is over, stocks start anticipating recovery. Waiting for certainty means missing the best gains. Remember that your income and expenses, not your portfolio value, determine your standard of living in the short term. If you have adequate income from Social Security, dividends, and bond interest to cover your expenses, it doesn't matter what your portfolio is worth this month. You're not selling it. You're just holding it while it recovers. Finally, remember why you're investing in the first place. For most people over 60, the goal is financial security throughout retirement, perhaps leaving something for heirs. A temporary decline in portfolio value doesn't change that goal. If you stay invested in quality, maintain adequate liquidity, and avoid emotional decisions, you'll achieve the goal regardless of what happens in any single year. That's my comprehensive strategy for growing 8 to 10% safely during a potential 2026 recession if you're over 60. Own quality equities for growth and dividend income. Hold short to intermediate bonds for stability and optionality. Maintain cash for emergencies and opportunities. Withdraw flexibly based on market conditions. Coordinate Social Security timing with portfolio strategy. Manage taxes actively during downturns. Stay invested through the scary parts. And maintain perspective that this too shall pass. It's not complicated, but it requires discipline. The strategy works over complete market cycles that include recessions. The only way it fails is if you abandon it at the worst moment. Master your emotions, trust the process, and you can achieve strong returns safely at any age. That's how I've invested for 8 decades, and it's how I'd invest today if I were over 60 and concerned about an upcoming recession. Let me leave you with one final thought that I think encapsulates everything I've discussed. The goal of investing in your 60s and beyond isn't to maximize returns at all costs. It's to achieve adequate returns with acceptable risk while maintaining peace of mind. 8 to 10% is adequate. It's enough to grow your wealth, outpace inflation, and fund a comfortable retirement that could last 3 decades. What's not acceptable is taking risks that could permanently impair your capital, speculating on hot stocks that could go to zero, using leverage that could wipe you out, concentrating in single positions that could collapse, selling in panic during a crash, and locking in losses. These are the behaviors that destroy wealth, not recessions themselves. Recessions are actually your ally if you're positioned correctly. They shake out the speculators and reward the patient. They create opportunities to buy quality at discounted prices. They remind everyone that risk is real and fundamentals matter. After 8 decades of investing, I've come to welcome recessions as cleansing events that set up the next leg of growth. So as you look toward 2026 and whatever economic conditions await, remember this: you don't need to predict the future to succeed. You just need to own quality, maintain liquidity, control your emotions, and stay invested through the full cycle. Do that. And 8 to 10% returns are not just possible, they're probable, even during recessions, even when you're over 60. The wisdom of building wealth late in life isn't fundamentally different from building it early. It's about patience, discipline, and trusting in the long-term power of quality businesses to compound value. The only difference is that you have less time, which means you can't afford mistakes. So make fewer mistakes by keeping things simple, focusing on quality, and avoiding the emotional traps that catch most investors. That's the blueprint for growing your wealth safely during uncertain times. It's worked for me through more recessions than I can count, and it will work for you too if you have the courage to follow it when following it is hardest. That's all investing really is. Doing the right thing consistently, especially when it's difficult. Master that, and everything else takes care of itself.